A phantom account is a type of bank account that is not explicitly listed on a company's general ledger but is used to record and track specific financial transactions. To understand phantom accounts, it is essential to break down the concept into smaller components and explore how they function in practice. Firstly, phantom accounts are often used by businesses to manage and track specific expenses or revenues that are not directly related to the company's core operations. For example, a company may have a phantom account to track the expenses related to a specific project or to manage the costs associated with a particular department. To set up a phantom account, a company will typically create a separate account in their accounting system that is not included in the general ledger. This account is then used to record all the transactions related to the specific expense or revenue being tracked. The phantom account is usually reconciled regularly to ensure that the transactions are accurately recorded and that the account is properly balanced. One of the key benefits of using phantom accounts is that they allow companies to track and analyze specific financial data without cluttering up the general ledger. This can make it easier to identify trends and patterns in the data and to make informed business decisions. Phantom accounts can also help companies to improve their financial reporting and to reduce the risk of errors or discrepancies in the accounting records. In practice, phantom accounts can be used in a variety of different contexts. For example, a company may use a phantom account to track the costs associated with a specific marketing campaign or to manage the expenses related to a particular employee. Phantom accounts can also be used to track the revenue generated by a specific product or service, or to manage the costs associated with a particular business unit. To get the most out of phantom accounts, it is essential to follow best practices and to ensure that the accounts are properly set up and managed. This includes regularly reconciling the phantom account and ensuring that all transactions are accurately recorded and up to date. It is also important to ensure that the phantom account is properly documented and that all relevant personnel have access to the information they need to manage the account effectively. In conclusion, phantom accounts are a useful tool for companies to track and manage specific financial transactions. By understanding how phantom accounts work and how they can be used in practice, companies can improve their financial reporting and reduce the risk of errors or discrepancies in the accounting records. By following best practices and ensuring that phantom accounts are properly set up and managed, companies can get the most out of this powerful financial management tool.